All right, we are back on Today with Denny. I'm excited about my next guest. I think, John, are you on the line?
Yes, Denny, I'm here.
Awesome. Folks, this is John Thur, a chartered financial analyst. Let me tell you, when he speaks, people stop and listen. He's been doing this. John, how long you been doing this? Over 40 years, right? Something like that?
Yeah, something like that. I started in kindergarten.
That's right. Yeah, they had child labor laws, but John helps run Independent Solutions, a great money management team that I'm happy to be partnered with. But John also runs this new private wealth division that, folks, you typically need 50 to $100 million to get the kind of services that John provides. And I want you to talk about what you do. But John, the first thing is, obviously the market's been getting crowbarred a little bit because of inflation. I talked about it on the show. I think inflation is showing the highest spike since the last 12, 13 years. I mean, what do you think about that?
Well, that's a good point to bring up, Denny, because it is the focus of the market now. And I think where we bring value in the years I've been doing this as a trader, as a research analyst, and a portfolio manager, both on the stock and the bond side of the market. How do you interpret this? Okay, and that's what's critical. What I look at, Denny, is the fear right now is that there's about 10 countries in the world, their central banks have either started to raise their short rate or they have tapered their buying of their sovereign debt. And what that means is, for example, the United States right now, the central bank is buying the debt of the Treasury. So our government runs a deficit. They turn around and borrow money to pay for that deficit or to fill the gap. And it typically goes to the market, and the market says, okay, we'll take that debt for X percent. Well, the Federal Reserve has come in and said, we're buying that. Don't worry. You guys go invest in riskier stuff. We're buying that debt. Well, they're holding their rates artificially low by buying the debt. So when countries stop or slow their purchases, that gets the regular capital market more involved, and they have to take on and buy and absorb that debt. So we're going through this period now where they're trying to return the risk determination to the market instead of letting the central banks do it. So if our Federal Reserve starts to taper, which means instead of buying, 120 million or billion bonds a month, they buy 80 billion. That means the market has to absorb the difference. Thereby, I believe rates should go higher. That's what the market's worried about.
I mean, the
Fed
has
been supporting this way too long.
Yeah, they have to. They have to start. And I think I had Paul on the show, Paul Meeks, and his thought process, like many, was, well, of course, it's so cheap to borrow right now. That's why they're doing it. But that could start changing soon, right, John?
Well, here's the way you look at it, Denny, or I look at it. I think the 10-year Treasury, historically, over my career, you price the 10-year at GDP growth, which is about 2%,
right,
plus inflation, which has been about 2%, and a premium of, 0.5 to 1%. So the 10-year should be somewhere around 4.5 or 5%.
Exactly.
But it's 1.6.
Right.
So if the 10-year were to go to 2.25, which is where I think it can go this year,
okay,
that is not high.
No.
Relative to where the economy is. So I don't think a 2.25 10-year will hurt the economy, but it will hurt hard assets, stocks, bonds, homes, real estate, things of this nature, have exploded to the upside because of low interest rates. So you'll see some, selling, or I shouldn't say that. You should see some correction in the price of assets, but you shouldn't see the economy get hurt. So if we don't think the economy will be hurt, what should we do? Well, when the assets come down and they reprice lower, I'm going to be buying. I'm going to be buying things that with new money that I'm getting that I haven't been buying because they've gotten too expensive.
Do you think
So
GDP?
I believe the economy will continue
Yes.
to have a decent year over the next 12 months or so. But I do believe interest rates on the long end will go up a bit. And we'll have to see, what the Fed does. But I don't think they'll react on the short end to it.
You think GDP, most people feel it should be between 6 and 8%. You think that's a pretty good guess?
Here's the problem with that, Denny. Everybody's freaking about these numbers.
Yes.
I really am not paying attention to any of these economic numbers,
Okay.
to be honest with you. Because last year we had a pandemic, and the second quarter is going to be even worse than the first quarter. By that, I mean the numbers are going to look outlandish relative to last year.
Of course.
What I'm doing is I'm looking at the numbers relative to 2019.
Gotcha. Right.
And a lot of my companies that are reporting earnings this quarter have done well, and their earnings are up substantial
compared to
over
last
the
year.
previous year.
Right.
But not many of them have eclipsed their 2019 sales or earnings. So you got to keep this in perspective. And you can't look at relative to last year's second quarter, which they're going to do again when the second quarter of this year is compared to on all the economic metrics and all the earnings and sales metrics. You kind of got to go back and look at where were we in 2019. 2019, Denny, we had an oversupply of everything. There was no inflation pressure because we had more supply of everything than we had demand. Why is that, Denny? Because we've kept interest rates so low, near zero. We've kept a lot of zombie companies alive that shouldn't be alive.
Yeah.
And there's just so much supply of everything, and there's no pricing power. So now all of a sudden, you're seeing the prices jump up because we had a bottleneck, because we shut down production for 3 to 5 months. And now we're getting a demand buildup where the supply hasn't come back online, because that's what they were waiting for, to see where the demand or when the demand would come back. That supply is going to catch up, Denny. And this whole inflation thing, I think, is going to subside, and we're going to be in a different place 6 to 12 months.
So you don't think the inflation will be hyper or spike out of control? It's just kind of catching up relative to last year. That's kind of like
temporary, in my opinion, due to a bottleneck of supply.
Okay.
But the demand is still not what it was in 2019.
So the demand
is lower. In 2019, we
Mm-hmm.
didn't have inflation pressures or a lack of supply.
Okay.
So that's where I'm going with it is, you got to keep it all in perspective. And we're just in the midst of a very difficult time. We're coming out of a pandemic when the government shut everything down pretty much. And now we're trying to open up. And there's going to be a dislocation between supply and demand for a little bit.
So, John, obviously you're not bullish on bonds, right?
Yeah, not at all, Denny. I haven't been for probably a couple of years. I think it's a dangerous place.
So what do you...
I think bonds are probably more dangerous right now, or risky than stocks. And I've pretty much stayed extremely short in my bond portfolios.
So into private wealth management, and again, this is not for everybody. This is not for the $40,000 a year person. But what do you... People looking for either yield or safety, they don't want to do equities. What type of strategies are you doing? Because you're not buying bonds. I get that.
No. Well, I'm not buying in the public market, Denny. I'm buying bonds and notes, but they're in the private market.
Got you.
There's a private market out there where capital is raised through a private means and not public.
Okay.
And what happens with private deals is you give up some liquidity. Whereas today, if I had a bond like a GE bond and I needed cash and I wanted to sell it, I could sell it.
Mm-hmm.
But with the private market, you get in and you commit, and you're in for the duration. So if I buy a 3-year note,
okay, I'm
in for 3 years.
Okay.
Okay. So you're giving up some liquidity. And what I'm doing with my clients who are high net worth individuals of, $1 million and up, and most of them multi-million, is I'm taking the bottom 20% of their assets. These are assets they're never going to touch.
Sure.
And I'm committing those to private deals. Why? Because in the private market, the risk reward ratio is far better than in the public market. The public markets have easy access, and therefore a lot of capital is flown into those markets, and they're way overpriced, I think. And because of that, I'm trying to get my clients portfolios into a lower risk profile with a better return. So, for example, I can do a 3-year note. Okay, it's a tax lien note, backed by tax liens, and I can do 7% for 3 years, 6% for 2, and 5% for a 1-year commitment. I can also do a note on a real estate project in Austin, Texas, one of the fastest growing markets in the country, from a developer that I know very well and have done business with before, and does a great job. And I can do a 3-year note there for 10%. I can do a 2-year note at 8%, and I can do a 1-year note at 7%, and I can even do a 3-year term for 6%.
Those are great rates, John.
I've got some options.
So the first thing that people are going to say is, well, John, how safe is my money doing in this? And your response would be,
I think I spend a lot of time, Denny, as you know, researching these things.
Absolutely. Yes.
And knowing who the players are.
Yes.
Knowing their strategy, looking at the probabilities of their ability to complete their strategy, looking at what's backing these notes.
Sure.
And then determining whether my clients are getting paid to take the risk. And what I try to do is boil it down to basically the liquidity risk. And if my clients can get a better return just for giving up liquidity, that's a no-brainer. So most of this, there is risk, but I don't believe the risk in what I'm finding out here is greater. It's in fact less than what I'm seeing in the marketplace. If somebody's willing to step up and own a high yield ETF or a high yield mutual fund,
yes,
I believe they're taking far greater risk than the risk my clients would be taking in some of these short-term notes for the return they're going to get.
And isn't that the simple?
People are taking risk in things they don't even know they're taking risk in, or they don't know the amount of risk they're taking. Mm-hmm. When I go to the private market, okay, let me explain to you. When I'm in the public market and I do an analysis on Microsoft, and I boil it down and say, I think Microsoft's worth $185 a share. That's what I'm willing to pay for it. Well, Microsoft's trading at $245. So I can't buy it. Well, right. I keep doing it and doing it and doing it, and I keep finding these companies that are way overpriced. So what do? I either buy nothing or I have to pay more for it. Because what happens is with all the indexing, people buying index-type ETFs or index-type mutual funds, they are forcing the market higher because nobody cares what Exxon's worth. Nobody cares what Microsoft's worth. They just want to buy the index and be involved. So they're pushing up. So my analysis is not as effective. When I go to the private market and I scour through all these deals and I find 2 or 3 gems, I put my time in, do the analysis, and I look at the risk and the reward, and I can determine right then and there if it's worth it, and they're not as volatile. So when the market's going up and down, the value of my clients' underlying assets in these private deals is pretty stable. You see what I'm saying?
Yeah,
so I can add value by doing the analysis. Whereas in the public market, it's hard to add that value because everything's so overpriced because of indexing.
And I think from a layman standpoint, which I am compared to you, just a layman, it's the simple, like you mentioned, liquidity. People can panic and press the sell button quickly, where in the private sector, that's not what happens. Come on, you know better than I, John, that prices are manipulated up and down by people either overbuying or overselling, seeing something on the news, and that affects often more than basic fundamentals. Isn't that true?
Right.
That's how the market works.
Exactly. You're right. And a lot of it is done with leverage too, Denny. And a lot of it is done with algorithms and programs that these guys run that tell them when to get in and get out. There's no real in fundamental analysis. It's more quantitative right now. Right. And that's what I'm explaining is when you go to the private market, you don't have to deal with any of that. Mm-hmm. There's no options on my positions. There's no leverage on my positions other than what they may have done in the deal, which I know about up front, but there's no outside leverage going on. There's no trading. It's just a stable steady investment.
There's nobody nobody shorting your position because they're still not over their childhood or their bad marriage.
Exactly.
Exactly. I try to explain this.
And I continue to obviously follow these closely. I have a great relationship because of the time I've spent researching them. some of them up to a year. Okay.
Before you
And
buy?
I've got a good relationship with those people, and I follow up and I keep informed on how the projects are doing, or, how the deals are going. And I can stay appraised of what's going on.
So, John, for those who are not well off, because you deal with high net, I mean, that one bond portfolio you ran, that was, what was it, like $1 billion in that one fund that you were doing with the fixed income years ago?
Oh, it was $1.5 billion.
Yeah.
And it was for an institution, and it was pretty much everything that you could trade in the fixed income and own in the fixed income side of the balance sheet. So, that was a great time, and I learned a lot about fixed income, about the yield curve, about a credit risk, and how to analyze all these different types of fixed income deals that are out there. But that's
so
part of my history.
Let's I have many clients who are not high net worth people, because my practice is I want to help everybody who's not a pain in the what. Okay. So what would you say to the average investor right now looking at the market with, let's say, a 5 to a 10-year horizon? Because let's face it, if you're investing in a market, you should never have shorter than a 5 to 10-year horizon, because at any given time, crazy things can happen. So what would you say? I
agree. And
to the average
I
investor?
Can't tell you how many people have told me how they got out in March.
Yeah.
And they never got back in.
Never got back
in. And that's that typical sell at the bottom, buy at the top. And now they want to get back in. So I'm trying to guide them and help them. But, Denny, the biggest advice I would give to people is don't chase returns.
Right.
Be a risk-based manager. Find somebody to help you who understands risk.
Mm-hmm.
And then design a portfolio for yourself that is built around your risk tolerance. And don't chase returns. The worst thing to do is look back in history and, this fund has a great track record. The last 3 years, it's really outperformed. Well, that's chasing return, because now a ton of money is going to go into that fund, because that's what people do.
Sure.
They buy at the top.
Sure.
And then all of a sudden the poor manager has to go out and buy everything that's expensive. And then the next 3 years they underperform. And when they do, then you get out. And that's what they call buying at the top, getting out at the bottom. Okay. And that's a horrible strategy. And too many people do it. So what you have to do is go to places that have underperformed, and go to stocks and find the ones that haven't performed yet. And that doesn't mean they're not good companies. For example, like a Nucor, that's a steel company. Now, I was looking at that a few months ago. I've owned it several times in my career. I really love the stock. I love the company. I love the management. Everything they do very well. And they've got a good history, but the stock has not performed. It's not a high-tech stock, and that's what everybody wants now, the instant gratification.
Sure.
And here's a stock that was a great balance sheet, great cash flows, very good business. They're worldwide. They're one of few, major steel producers left. So there's huge barriers to entry. And I bought it between $51 and $57. And it was trading only at 11 times earnings. And great, low price to sales, low price to book. It was just a classic stock, right? And I figured over the next 2-3 years, that if the economy does what we think it can do, that stock should do pretty well, better than average.
Sure.
Well, here it is today at $100 a share. 3 months later.
Well,
so that stock was on its butt forever. But I know how good the company is, and I know I'm buying something very cheap. And all I have to do is be patient. And that's what I do a lot of times, Denny, is I buy things that nobody wants. I know they're good companies, and I just have to wait. So my clients understand that if you wait 2 years and the stock does nothing, but in the third year it doubles, you just doubled your money in 3 years. And that's phenomenal. And that's what I try to do is set my goals on each company I purchase to double in 3 to 5 years.
Well, here's the thing,
those are my goals,
John. When volatility, which looks like it's starting to rear its ugly head, happens, my business typically does better, because let's face it, everyone was a genius the last few years before the pandemic, and that's just not reality. I mean, if you look at what the S&P has actually returned in the last 21 years, it's probably somewhere around 5%. It's not what people think it is. That's taken into account 2008. It always changes. It was at 3.5% for the longest time. But if you compound interest on top of that, my whole point is managed assets and using people like you is a smart way to go. Doesn't mean that you're going to guarantee returns. It's not an annuity. It's not FDIC. But it's like you say, risk reward. Doesn't mean you have to buy high-tech companies. There are a lot of preferreds out there that pay a pretty good dividend. So, folks, if you want to get professionally managed advice, please give me a call, 561-305-8226. That's 561-305-8226. If you are a higher net worth type of individual, that's where John's forte comes into play. And really, independent solutions, John, besides the private wealth, what is the minimum for independent solutions for people to have a managed account there? Is there a minimum?
Well,
I don't remember.
Well, right. What we do, Denny, is there's some minimums, all right, but not many. And the one thing is, if you want to get exposed to my research and my stock picking, or Paul Meeks, or Dave Marriott, or Dan Neiman, we have models we put together.
Yes.
So that for people who don't have a lot of money, yet, and you can grow, and when you do, you can move into the wealth group, but it's a minimum of $100,000 to get into one of our models. And I think that's not a bad way to go.
That's very reasonable. Very reasonable.
My model is more, as you know, of a blend. It's some small, some mid, and mostly large cap. It's some growth and some value. And it's some value that turns into growth. So I kind of cover the whole spectrum. And I'm not performing every quarter. That's not my goal. My goal is to perform on a 1, a 3, a 5, and a 10-year number. And like I said, sometimes I buy things and it may take 2 years for it to bloom.
Sure.
But then that third year it doubles and you get your return that you're looking for.
The return,
and when you do it that way, you do it with a lower risk profile than the market. And you can pick and choose your spots to take risk. And you're not taking the whole market risk. And that's the key. And that's what we do in the wealth group too, is to decide when to ramp up the risk, when to pull the risk back. And most of our clients are wealthy, to be honest with you, and they don't need to get rich. They're rich.
Exactly.
They want to protect what they've got.
Preserve.
They want to participate in the market in a smart way.
John,
so they can sleep at night.
We have 2 minutes to go. I want to thank you. I want to have you back on the show. Independent Solutions does a fantastic job, not just because of the returns, but the service. Folks, you can actually get the fund managers on the phone to have a meeting to discuss your personal portfolio. You just don't get that with most money managers. You really don't. John, thank you, my brother. I will talk to you soon, and let's have you back on the show. John Thur, ladies and gentlemen. I think we have like a minute left or so. Folks, if you're interested in a wealth manager or having a managed portfolio, please give me a call, 561-305-8226. It's a lot simpler than you think. And I think, the key is risk reward. I know people like returns, but I don't know too many people that really want to take as much risk as the market. And that's what I'm talking about. Hopefully you'll come to the show on the 21st, the Santana Tribute. And hopefully Evan will get more than 4 hours sleep tonight. And he's going to shave this weekend. He's going to look great. Thanks for tuning in on Today with Denny. Make it a great day as always. And please stay out of the heat. It's getting hot out there.